Good morning, traders. It's 8:01 a.m. Chicago time, 9:01 Eastern on the 19th of July, 2017. It is Wednesday, hump day, middle of the week. Thanks for joining me again for another Trader Bite. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The market stance this morning is clearly bullish. Allocation is to risk this morning. The Nasdaq leading the pack, up 17.5 points at 0.3%. The laggard today is the euro, still trading higher than week on week. It's trading at $1.15 and 63, but it is down 35 pips at 0.3%, followed by the DAX again, lower today, but only about a point and a half, so not much, 0.01%. The Russell this morning is unchanged, but the yen, oddly enough, the yen is fairly relatively strong. Everything is green on my screen except for the euro and the DAX. That's where the market stands currently. The overnight news was very light. The key release this morning was Morgan Stanley. Morgan Stanley reported at 5:55 a.m. Central, 6:55 a.m. Eastern. It reported 87 cents versus 76 expected, 9.5 billion in revenue versus 9.28. It is raising its dividend by 25% to a quarter per share, up from 20 cents per share. So still good earnings news flowing. Other than that, looking at events overnight, very, very, very light. There isn't really anything to talk about. Yesterday, the equity indices, the Nasdaq and the S&P pushed into record territory. The futures in the S&P did not. Also, for those of you who have been watching, the shares of Snapchat got down to 1473, down 13.3% since its initial public offering. And then other than that, it's just a bunch of news on stocks I won't cover. Today, we're looking for, one second. Today, we had at 8:30 Eastern, we had the U.S. June housing starts 1.22 million versus 1.16, beating. Building permits 1.25 versus 1.2, also beating. Other than that, we have crude oil at 10:30 Eastern. The number for crude, we're looking for a draw of negative of 3.6 million. Distillate inventories, we're looking for a surplus of 1.5 million, and on gasoline inventories, we're looking for a draw of 1.386. So a draw of 3.6 in crude, surplus in distillates of 1.5, and gasoline down 1.386. That comes out at 10:30. Other than that, the calendar's clear. Expected to be a quiet day as far as economic releases. However, we still might see a fair amount coming out of Washington regarding this healthcare bill. Let's move on to what we expected yesterday. And by the way, I'm going to take a few minutes to talk about risk and talk about an element that keeps just biting traders over and over again at the end, if you want to stick around for that. It's slow trading. It is summer trading, so there isn't much I can shed on the situation here to make it interesting or whatever. I'm not here to entertain. I'm here to just basically go over my my plans with you so that you could follow if you want or refine your process. Yesterday, expected an open auction out of range. Expected the market to test up first. So looking for an up test first, and then looking for it to fail in the value low area of 24.56, and then was looking for the market to reject and hold lower and build this profile a little bit lower. That didn't happen. What actually happened almost to the dot is the market is likely to open, test down, then push up to test the prior day's range, then push up into value low, then push up into the point of control, and then rest somewhere inside of the prior day's range. So that's what was expected. So again, drop, set a base, impulse up into the prior day's range, impulse up into the prior day's value, then chop into finally the point of control, then finish down. Okay, here's what actually happened. So the interruption that occurred on the healthcare stuff disrupted the trade a little bit right here. We can see that the news came out, it dropped deeper than expected, and then back to the scene of the crime. The auction resumed, but this was hypo 2 on the dot. We dropped right down into that 51.50, 50.50 area. We went to 50, so we pushed by 2 ticks. Initial test of the prior day's low by 2 ticks. Then it pulled back. This drop was excessive because of news. Expected to drop back into the open and the mid, and then the next test right to 56 right there. See that 56? Then chop around, pull back, then move up, and then right to the point of control. Missed it by a tick. The point of control is at 58.75, and the high is at 58.50. Expected a turn down on the close, which we didn't get. But this is hypo 2 pretty much on the dot. It doesn't get cleaner than that, really, especially on a boring summer day. So this is very orderly, and because it's very orderly, we can more accurately predict the auction going forward. And in this circumstance, what we've done is we've rejected prices down here. Now, even without this excess low that we put in, the expectation is for the market to continue higher. Now that it found its buyers, it dipped down, so we've balanced for 2 days. We dipped down and we're back in the range. See where we closed? We closed right in the point of control. So we've tested below. So this is what the auction did. It advertised prices lower. It found its buyers and it rotated back up through to where the balance was over the last 2 days, where these high volume nodes are, and it closed with a high volume node right at the top. So the expectation is for new all-time highs again, expecting the market to continue to ride higher. Look at this delta all afternoon, all morning, all afternoon, just pointing up. So the market was very orderly yesterday after the news was taken back. Since then, oh, didn't mean to do that. Since then, what we've done overnight is basically sit sideways through the overnight session. We sat sideways. We took out the prior high to at 60.50 to 61, sat completely sideways until the release at 7:30, where we pushed to 61 and a quarter. It is the buyers are in control. The buyers are pushing, but we're not far from yesterday's close. The overnight inventories are likely to be balanced by the time the market opens. You can see here delta is fairly balanced. There isn't a winner in the overnight session, and volume is not so great. So let me erase this and push this up. Volume is 123,000, a little light. A little lighter than usual. But overall, I think participation is pretty good on the buy side. But as you know, as we push to new all-time highs, the market has a hard time. So we're right at all-time highs here at 61 and a quarter. The market's just having a hard time making a push with the overnight crowd. But we're likely to squeeze on the open. Okay. So with that, let's take a look at what we're expecting today. So we're going to include yesterday's volume. So you're watching to the left, watching how the volume is influencing this profile right here. We're seeing where the market filled in and how the auction is progressing. Okay, so you can see it filled in below on that news, but then it starts to fill in and continue to push that MC point of control, which I have to move in the flex levels, continuing to push that higher and higher. We are accepting higher prices as fair, and the MC point of control is now the overnight low, is the same as the overnight low. The market is using that as a base, so it's likely to squeeze through to the top side. Okay, so this morning we are trading. This morning we're trading right on the edge of the high of the all-time high. The market is likely to open in an open auction. I'm looking for a dip down into this 57.75 area, potential test through, but ultimately the impulse move is likely to be to the upside. I'm looking for a test to 65.50 and then for the market to settle somewhere inside of the range here to flow back in, potentially closing in this 60 to 61 and a quarter area. That's what I'm looking for today. That's hypo one. That is the most likely scenario. So once we dip below, we're starting to push up, and then I'm looking for a continuation of that auction higher. So here we're looking for 65.50 as a measured move target right now. Oops. As a measured move target. I'm not looking for too much range today. The range is likely to be less than 10 points as we push new all-time highs. And we'll see how that goes. Alternatively, looking for a push higher into new all-time highs, and then we get an impulse down. So the greater move is downwards. It attempts to push to the high again, gets down into the 57.75, and then starts pushing down into 54 before it bounces back up and closes in this 57.75 area. That's hypo 2. So what cues me in on hypo 2? It is the impulse down. You know, which side gets the bigger participation, which side gets gets better delta on its moves. That gives me a clue. It's not affirmative evidence. Nothing really is in trading, um, but it gives me a strong clue that the sellers would be in control in hypo 2. Okay, so those are the two main ideas today. The last thing I wanted to talk about before I let you go here is our perception of risk. I've talked about this before a little bit. It's really important for all traders to understand the nature of risk, the nature of how we deal with risk. And the reason I say this is I'm sure many of you, especially in the United States, own cars. And if it's a new car, you'll start to, once the warranty is about to run out after 3 years or 2 years or 5 years, depending on the car model or car maker, you start to get pestered by these warranties, these extended warranties that you can buy for your car. For example, I own a Range Rover. I get Range Rover Sport. I get all these cards in the mail and emails and so forth. I'm sure the dealer sold my name, uh, telling me to buy an extended warranty for the car for another extended warranty for 2 years for $4,000 or something. This speaks who is the customer and why would they do this? Why would they want to sell warranty on car repairs, extending the warranty? And who are the customers that would buy that? The reason they do this, and they do this feverishly, is because there's a lot of profit in it. The reason there's a lot of profit in it, because by nature, as human beings, we uh, often overemphasize the risk involved in any given situation. We are survivalists, and so you're likely to want to opt for the safer option, and that's why insurance is such a big business. It's so my point here is not to tell you not to mind risk. My point here is to tell you that as a trader, you are likely to overemphasize risk. It doesn't mean you take your stop off. It doesn't mean you trade without stops. It doesn't mean that you just disregard risk because you're contrarian to human nature. It just means that be aware that you are likely choking your trades off a lot if you're not seeing consistency, and you are likely overemphasizing the risk involved with any given trade. Many of us just trying to make our way through the labyrinth of trading have likely seen where we take a trade off, it doesn't look good, we take it off, and then it goes according to our hypo or according to the expectation. Then we get on a day that is trending, and we decide to extend our stop, and then that particular trade day, because it's moving around, it's starting to trend. That particular day, we give it too much risk, or we take our stop off completely and wipe away 30% of our account. Everybody's done this. Everybody's had a blowout day. You're not unique in that sense. But my intent here is to tell you, be objective about risk. Look at risk as something that is absolutely necessary to you making money. Define what that is. What do you want that to be? Don't choke the trade. You know, if the product has an ebb and flow of a certain number of ticks and your stop is within those ticks, then chances are your stop is always going to be triggered, your percent loss is always going to be high, your profit factor is going to be low, and you're losing money in addition to cost. So consider what you're trying, what the market is telling you as the potential for the market holding that position. Where can it be wrong? Determine what that is. Decide that that would be your risk. And if it's too wide, if you find that, oh my God, it's 6 points away in the ES, then you're probably trading too big a time frame, or you're trying to take a position in a setup that is not for you because you don't have the account size to justify taking that position. But give the trade room to work. Your goal is to put on as many trades as you can over your career, and the intent is to have that edge show up if you have one. And it'll never show up if you keep interfering with the trades and using 4 tick or 3 tick stops or scratching trades, holding on to losses and so on. So just understand that our nature, and I'm using the example of the extended warranty on cars as the reason. This is why insurance companies will sell you insurance on anything. It's because we tend to overvalue risk. And so those people who are, by the way, the answer for whether or not you should buy an extended warranty is, of course, a personal situation. But pretty much everything I've read and my own assessment says it is better for me to just put $100 away a month and get multiple quotes and pay for a car repair out of my pocket than to buy one of those insurance plans. You're prepaying you're basically buying a call option on a potential issue with the car, and if it expires, then that premium of $4,000 over 2 years will never be recovered. But if you just put the money away over 2 years, $200 a month, you would be better off because the money will be there if you don't use it. So you understand that there's a big business there, and the reason there's a big business there is because people are very risk averse. Anyway, I just want to make it a point. Just think about that and assess according to your particular situation, your time frame, and so on. If you find that every time you identify where risk is, it's too far for your product, chances are you're trading too big a time frame for your account size. The smaller the account size, the smaller your time frame has to be. Um, if you're position trading, you won't want to position trade with $1,000 account in the ES. It's too much leverage over a period of time. You can't even cover margin. So just make those adjustments, and you may see and then track your performance. You may see a better return on your time and effort. Good luck today.